Hello, and welcome to the stock-specific class here for Thursday, May the 26th. As always, if you have any questions during the week or any questions I don't get to in the live class, make sure you send those to jerry@traderspro.com. Quick reminder, too, before we get started, the market is closed on this upcoming Monday for Memorial Day. So just be aware of that. I've had it happen before. Usually it's the Friday holidays that mess me up because most of them are the Monday holidays. But I've had situations where, and it's usually something like the Good Friday holiday that you're not, it's not the most obvious holiday or what have you, and I'll forget that it's closed, and especially if I've got options or something like that expire. Luckily, that hasn't happened very often. Usually, when you have a trade that expires like that, you're on top of things. When the expiration date might be a day earlier. But anyway, let's get started. We're starting to see what I was expecting the market to do all along, and we'll look at the charts here in just a second. Remember, Tuesday we got thrown off by that snap news. The market dropped suddenly, and I gave you my little rant about that, and didn't think that it was going to cause the market to roll over right there, and so far it hasn't. But now we've rallied a couple days here, but we're getting to levels where we have to start to look to see if there's going to be another bearish reversal. Now, sometimes when we're doing this in class and we're pointing out some of these levels, all I'm really showing you is I'm showing you as a chart technician, I'm showing you areas where traders are focused on. Okay. Again, I'm not unique. Anyone that knows how to read this stuff and has been trained to look for this stuff knows where these support and resistance levels are. You'll get there too the more you work at it. I started where you're at now if you're brand new, and it is possible. If I can do it, anyone can do it. But the point I'm trying to make is sometimes when you look at these levels, you'll see the market react almost exactly like you said it would, and you can start to feel like you're a genius, or that you're psychic, or that you know what's going to happen next. Other people might think that of you, that you can know what's going to happen next. But as I keep telling you, the market will always find a way to make sure that doesn't happen, at least on a constant basis. So although we'll point out an area where we think the market could reverse, part of the reason for that is I still feel like we're in this downtrend. I still feel like this is a rally within a downtrend, and it would have to break above these certain levels to start to change that larger mindset, a longer term mindset, and we get to the charts. I'll show you what I would be looking for as far as, could this be a little bit larger rally or what have you. Part of the problem in really convincing me that this is the bottom and we're done is just that we haven't had any panic selling. We haven't had any fear, and not even a little bit where we could say that might be fearful enough to be a bottom. We haven't even been close. So it's like, we're just now starting to see companies lower their guidance. NVIDIA yesterday, although the stock is trading up today, lowered their expectations. Obviously, Snap earlier in the week dramatically lowered their expectations. I think we're going to start to see more and more companies come out and do that. If they're smart, they'd come out and do that, because once the first person comes out and starts lowering stuff, and they get clobbered, that's the best time to come out and do it, because the people who get clobbered the most are the people who are the first ones that report, and then the ones that wait till the very end, they're hoping they don't have to report lowered forecasts, that the economy will turn right around, go back up, and they'll be fine. And then they report late and they get hammered for that. So we'll see if that starts to take place. I wouldn't be surprised if we start seeing more and more companies come out, and the reason that it could create some volatility coming forward is just like with Snap, is that they just had their earnings report a couple weeks ago. That's when people expect to hear the bad news or expect to hear the lower guidance, or the positive news that they expected on that date. So when you come out unexpectedly and break the news, especially 2 weeks later, that freaks the market out because they're not expecting it. They're not expecting that to take place at that time. It's coming out of nowhere. It's not around that earnings date. And so if you think about it, if we start having companies out of nowhere start coming out and reporting, obviously that starts to scare traders because they're like, okay, I can't wait for the unknown to take place. I better start selling. I better start getting out of stuff. And that's what can start to lead to that indiscriminate selling is again, the feeling of not having control over the situation or over your trading system or what have you. And these professionals can start to panic when that starts to take place. So we'll look for that, see if that ends up happening here. As far as the direction alerts, we're starting to inch closer to that left side of the bear market. We're not there yet. It'd take another sell-off to get there, and the market's obviously been rallying. In fact, with the rally today, it'll probably tick closer to this -4 here tomorrow when it updates overnight. But like I mentioned on Tuesday, not much has changed here. Remember, I said we're not in extreme oversold condition, so we could sell off and become more extreme, or we could rally and move a little bit this way. These aren't really telling us anything significant right now, except for that we could go either way right here. Usually these are going to be more helpful when they're getting to those or close to those extreme levels, and that lines up with the chart behavior, chart movement as well. So not much to comment on as far as those are concerned. Buy-sell ratios, we are seeing that come a lot closer together. Now, relatively speaking, it still is pretty wide. I mean, you look back here, it's about as wide as some of these areas back here. And you can see this was a pretty wide, unusually wide gap there between the buys and the sells. But it's been closing, and this will close even further when it updates today's rally in there as well. Sentiment is still, again, it can go either way, not any extreme level there. So let's get to the charts. One of the things I talked about on Tuesday was I said we want to pay attention to this area right into here, about that 410, 411. There's also this area right into here. So this is a resistance zone or area. Now we're really close to it today with the really strong rally today. This is actually setting up pretty nice because, again, what we're talking about is the possibility this is wave A, wave B, and this is wave C, creating that bearish ABC pattern. The problem is that when you have a strong day like today, if it closes right at the highs of the day, you wouldn't expect it to just turn around and go down the next day, although it's possible. Usually what I start to look for when I see a stock getting close to a resistance area is, do you get, and especially you've had now a couple days where we've rallied here, do we get a gap up tomorrow and then a reversal where we end up closing lower than where we opened. So if we gap up right to this area right here, and then by the end of tomorrow, we're trading lower than the open, that would be the bearish reversal that we would be looking for. That'd be really, it'd be nice if we get it. We don't always get something that's that obvious, but psychologically, what would be taking place that day? Well, obviously, it would still show the market is up again, right? Because it could still be closing higher than where it closed the day before. And so what everyone on TV will be talking about is we've had the third straight day of the market going higher. We haven't seen that in a while. Could this be the end of the decline? And could we be at a bottom and all this stuff? And then that's when everyone gets clobbered. If it, with that bearish reversal candle, it would drop. It'd likely drop the next day and start heading lower. So we'll see if it doesn't always play out exactly that way, but it could end up being a bearish inside day. We are close enough to that resistance area where maybe we do gap down tomorrow and then close lower than where we opened, and this would be a bearish inside day. Remember, an inside day is you want it to be inside of the candle of the day before and in the opposite direction. So this was an up day, this would be a down day. That's not the strongest reversal signal, but in other words, I've seen the market shake that off and still go higher off of that. But what the bottom line is, we're at a point now where tomorrow we're looking for any sort of signal that could show weakness or buying exhaustion, or sellers getting a little bit more confident. Now, on the other hand, again, we're not just trying to dig into a predetermined bias and stick with it no matter what. And we're not trying to assume that we know exactly how the market's going to play out tomorrow. Remember, I told you this is why we do this. Is we're like a football coach who doesn't know what the other team is necessarily going to do. You could watch film on that other team and see all their games and say, okay, they have a tendency to do this. They tend to run the ball all the time, so we're going to expect that they're going to likely run the ball. But I better be prepared for anything. So you start going over different scenarios. Okay, what if they line up like this? Could that be a pass? And you start preparing yourself for the unknown or for the surprise or what have you. And that's all we're doing here. We're saying, okay, if we're bearish, what are we looking for over the next few days? This is what I just did. This is our bearish analysis here. Okay, what would tell me that I'm wrong about that analysis and maybe we are going to rally up a little bit higher? Well, the most obvious is we get above this range right here. Now, we need to close above that range. Just trading above it, you get above it for a little bit, and then you come back come back below it. It's not showing that. It's not showing strength. And so you'd want it to close above there. Now, that would take another day like today and maybe even stronger to close above that. So it could take a couple days if we're going to keep going higher. So maybe tomorrow we get up into this range here. And then Wednesday, remember markets close on Monday. Tuesday, we'll actually get in this range on Friday. And then Tuesday, we have another up day where we break out of that range. That could be something that could happen. And now you're talking about 4 trading days in a row where you're moving higher and you're getting above that resistance zone. Okay, so that would start to turn me a little bit more bullish. It doesn't mean I'd be going all in, but you'd have to start looking around at getting into some new positions. Now, I'd probably stick with the ones that are working. I've got energy. I've got energy and oil. I've got the defense companies. I'd probably be sticking to that trade because those have held up pretty well. right now, I don't really. I'm positioned right now the way I want to be positioned. I still don't want to have. I don't want to be all in yet on the portfolio. I've got the positions that are outperforming other sectors, and I don't feel the need to get into more energy stocks to where you're really loaded up, and then you have the oil have a bad day, and you've wiped out all the gains you've made over the last several weeks. So I'm pretty comfortable with how we're positioned here. But if you have nothing right now, if you break out above this level, you could start to add a few trades into your portfolio, because you just don't know. It's possible that could end up being a bottom. Although, if you remember back in March, again, it kind of looked like the same thing, where this is maybe wave A, wave B, wave C. We got back up to this level up here, and we just kept going and going and going. But it didn't last. That was still just a rally within the downtrend, and we had this bigger decline after that took place. The same thing could happen here, where it starts to move higher, looks like it's reversing, and then really one of these days the rally is going to reverse and trigger the panic selling. It's just that you can tell how hard it is to know exactly when that's going to be. I mean, I thought it was going to be when we broke below this zone a while back, and it just didn't happen. And so, and it's been my experience, though, and this is part of the problem. It's been my experience that usually these panic sell-offs are triggered by something. They're triggered by, back in 2008, it was, the Lehman Brothers collapse, and the financial collapse. You had the real estate collapse at the same time, and it might be something like that happens a lot of times when the markets sell off like this. Especially when we've had this bullish run. Remember, we talked about how the bullish run was unique. It was stronger than we've seen in years. In fact, I think it was the strongest rally that we've had in the history of the markets, coming off that COVID low to the peak that we had last year, or earlier. Was it last year or earlier this year when we peaked on that? End of the year, right back up here. So there's institutions out there that start to get greedy, they get confident, they feel like they can take more risk, and they get a little bit too levered. And it's usually below the surface. As long as the market keeps doing what it had been doing, they'll be fine. But as soon as it starts selling off like this, they get caught. And what they're hoping for is that the market will recover and come back, and no one will know that they got too levered up and that they're about to go bust. Their fund is about to get blown up. But then at some point you get the selling that just causes their fund to blow up. That gets announced, and then that's when everyone freaks out. Now, it doesn't have to be a fund necessarily. It could be, it could be a speculative group. You look at maybe the SPACs that were really big a couple of years ago. Maybe you start to see a huge, bankruptcy as far as those are concerned, going belly up, or some of these smaller companies, again, going bankrupt or what have you. Maybe it's something like that. I don't know. But usually there's some sort of trigger that causes the big panic selling. And obviously we can't know what that is ahead of time. We're not psychic, but what we hope for is that the market warns us about it ahead of time, so we can see. So what could happen is we could see a bearish reversal candle up in here at this resistance area. We could maybe even see the market start dropping again, and then maybe some breaking news comes out, and that's what creates that panic sell-off. And so I've been through a number of these, and if you could go back and view recordings I had previous to some of these, I've come out and said, the chart is saying something big is about to happen. This happened right before COVID. We got a great reversal about 3 or 4 days before COVID, and I said the charts are saying something big is about to happen. I don't know exactly. Well, at that time you knew that COVID was in the news, so you thought it could be COVID related that caused the trigger. And sure enough, man, that caused the panic. As soon as we shut down, everything shut down. In fact, I remember the day it was when that basketball game, because I live in Utah, and there was a Utah Jazz basketball game that was shut down in Oklahoma City. And then everything got shut down right after that. Government shut up businesses and things like that. So again, trying to predict exactly what the trigger is going to be impossible, but we can pay attention to these areas. And most of the time you get a little bit of a clue ahead of time. And if you're paying attention to the price action of the chart, to the trend, you can be prepared to take advantage of that. Now, how could we take advantage of it? On Traders Pro, well, remember, we've been using those inverse ETFs, the SOXS and the SARK, SARK, and that's made a lot of the profits on the decline. Those have gone up in value when the market's gone down in value, and we'll continue to use those. And we can look at a couple others you could add as well if you wanted to use some different ones. But the bottom line is that we still want to be in mostly a cash position, because when we do get that flush sell-off, like I said, that's when we want to go in, and we're not going to be worried about picking the exact bottom at that point. We'll know that we're pretty darn close at that point, and we can make a killing on the way up when things start to recover. All right, so that's the S&P chart. The other charts, I do want to go to, well, you look at here's the Dow chart. You can see the Dow, well, it's trading pretty close to that previous high over here. This is that ABC, but it's already trading into that zone on the Dow. This is that zone, that's the same zone on the S&P, and it could be breaking above that. So that's something to keep an eye on. And the Dow has held up a lot better than the other indexes, mostly because you don't have a lot of the risk, the small cap risky trades in those other businesses or in those other indexes. But if these start to really collapse, now you've got the big, large companies that are really having trouble. That's when you know that things are really getting bad when that starts to happen. They've been the ones trying to hold things up, and it makes sense. When people get scared, they want to go with companies they know aren't going to go out of business overnight. They get out of the small cap risky electric vehicle stocks, and they go into Dow Chemical or Exxon Mobil or JP Morgan or something like that, to where they feel a lot safer. Now, I did show you on, here's the Nasdaq chart. Nasdaq has a little ways to go. Again, this is the one that's been beaten up a lot. Here's that range here for the Nasdaq, and you can see we're pretty far away from that. That's another thing to point out, is you'd like to see all the indexes get above that key level before you turn overly bullish. And so that's something that could probably take a few more days if you're waiting for the Nasdaq to get above that key level. But that's something to keep an eye on as well in the next few days. Obviously, we'll have class next Tuesday, and we can see where we're at that point. But now the Russell 2000, if you remember on Tuesday, I was telling you this is probably a better example of that bearish ABC pattern that I was expecting to take place. You had this impulsive move up for wave A. I told you wave Bs, they tend to be more choppy. So we were kind of chopping back down through here. And then wave C is a little bit more impulsive. And again, another thing I showed you was that I kept doing this where I'd show you that, you know, wave C would get up into maybe this area right here. Actually, that would line up perfectly with this, that same zone. And the reason why I kind of arbitrarily picked that distance would be that it's part of the ABC pattern that wave C will tend to be about the same length as wave A. Keyword is about. It can be a little bit shorter, a little bit longer, but it's usually about the same length. And so that gives you an idea of how far you, if that is a bearish ABC pattern, you're gonna head lower. This is the area right here where it would start to reverse and go lower. And so that's something to keep an eye on as well. We'll watch the small caps and see if it has any sort of reversal at that point. By the way, it would be very bullish if the small caps break out above here as well. Small caps tend to be a leading indicator. So they were the small caps collapsed first. They were the ones that declined when the market started to drop. They started to drop first, and it makes sense. Again, those professional traders getting out of those riskier companies, getting into the solid companies that are making money. They're not speculative. When we bottom down, we're in a true rally back up. It should be the small caps that lead the way back up. People will feel confident to go back into those. Because if you look at a lot of those small cap names, that they're just hammered. You know, you look at some of the fintech names, and they've just been obliterated. Yeah, it doesn't mean they still couldn't go down a little bit further, but when money starts pouring back into those companies again, that's when you know that you're probably in a bottoming situation and moving back up. Because it'll typically be the Russell 2000 that leads the way, so it'll lead the way back up as well. All right, so let's quickly go through the other charts here. TLT, I told you we did actually barely break above this area yesterday, but remember I told you this kind of choppy behavior was probably just a correction for another move down, and it's looking that way with it starting to move a little bit lower today. It could still kind of chop around a little bit before that, but that it still looks like it's still acting like it wants to continue to go down. Typically, what I like to see at a bottom is and I've shown you this a few times, is that impulsive down and then impulsive up. It's a clear impulsive up and then corrective. We got a little impulsive up right here, but you know, the fact that we're just kind of slugging along right here, this is more corrective. Remember what creates the bearish ABC pattern is that it's trying to rally, but it can't rally. It's sluggish. It just can't get any momentum there, and it's showing up on the chart with that back and forth movement. And whenever you see a stock moving sideways or sluggish like that, you want to pay attention to the direction it was moving in before it started that sluggish move. That's where it's more likely to go after it's done with that sluggish move. You can see it here. It impulsive down, then it was trying to rally, but it was sluggish. And then bam, when it dropped sharply, and then trying to rally, sluggish, bam. You know, you got to understand that trend behavior. It's not going to always work perfectly, or it's not always going to move perfectly like that, but it does enough times to where you can have a general sense of where it's going. And when it's erratic, by the way, if you see a stock that is doing something like this, and it has no predictable movement to it, I move on. Why? There's thousands of other stocks that are moving in the more traditional trend. They're acting like the typical trends. How trends typically act. Why? Because this chart is telling me something too. It's not like it's it's telling me this stock doesn't know where the hell it wants to go. So if I'm going to get into that chart and say, okay, I think I know where you're going to go, and it's telling me no, you don't, because I don't know where I want to go. You see where the problem is right there? You're trying to force a direction, and believe me, you can find your reasons. I can say, oh boy, this stock though, everyone's going to be eating gumballs in the next year. They're going to be the most popular candy in the world. I know the stock is going to go up. Okay, maybe that's true, but it's not telling you that right now. It's telling it doesn't know where it wants to go. So always remember that when you're looking at your charts. This is why I don't like to know what companies do, because a lot of that stuff can bias you into what you're reading on the chart. The chart will tell you. And if just like that, you could find reasons to either not believe the chart or try to go against what the chart is doing, but that's where you get into trouble. That's where, again, our job is not to be smarter than everyone else. Our job is to get really good at following what the professionals are doing. Let them spend all that money analyzing these companies, analyzing the economic conditions. They've got the smartest people in the world to do that. They've got the best computer programs to analyze these companies. And when they like it, and when their smart people say to buy it, it's going to show up on the charts. And we're going to just get really good at reading what they're doing. And that's where our area of expertise, where we're going to become experts at. And then that's our competitive advantage. That's where we can compete with those big boys. All right. So TLT looks like it's still trending down. Gold, you've heard my opinion on gold. It's been trending up, but it's been pretty erratic. We'll see if this is just a pullback within the uptrend. See if you can get a higher low right there at some point. If not, if it comes back down again, you're assuming it's still in this near-term downtrend. Oil's breaking out, though. That's something to pay attention to. And I have a trade on USO, so this is working out just fine. This is what we call a triangle or a wedge formation. Now, the rule of thumb when you start breaking out of this formation is you can take the base of the triangle or the base of the wedge right here. You can take this distance right here, and you can project that upward. So we're looking about up here. And that's kind of your next target of where you could expect this to get to. Now, again, it doesn't mean it's going to go straight there. Doesn't mean it has to go there. But something isn't a rule of thumb if it rarely happens. It's a rule of thumb because it happens enough that you pay attention to it. It's also not a law, meaning it doesn't have to do it or it's guaranteed to do it. But that gives us a lot of confidence that oil still has a little bit of a run to keep going on. And the fact that it's been in this wedge for so long is a really bullish sign that it's breaking out. So definitely want to be in oil stocks right now, or just oil in general. You can trade it with the USO. That's why we have it in the portfolio. But now, again, is it going to close that way? That would be could we fade into the close somehow? Yeah, so you'd have to be aware of that. Maybe it won't break out. It won't close above the range there. But it's looking like it will, and it's looking pretty good so far. Yeah, that was a good comment there. I talked about my rant earlier, the confirmation bias. We can cause ourselves to believe whatever we want to believe. But that's why it's so critical that you learn how to read these ranges. So how do you combat that? Well, you make sure you take the opposite side. You notice how very rarely do I just come out and say, this is what's going to happen. I try to look at both sides. Okay, this is what should happen if the bearish scenario works out. This is what should happen if I need to turn more bullish, this is what's going to cause me to turn more bullish. You force yourself to take both sides, and then that way, you don't allow yourself to dig in so much that you can't see the other side, and that's one way to kind of combat that bias that can creep in. The dollar, talked about this is looking more like a trend reversal. Okay, you have impulsive, corrective, impulsive up, impulsive down, and then look right in here. We're starting to move a little bit sideways. It's looking a little bit corrective. That should lead to another drop. Now, sometimes these corrective moves can rally a little bit. They can move up a little bit, but they'll tend to be more choppy, and then you'd expect it to come back down. So it's acting like a trend reversal right now. The dollar is. We'll see if that continues. And by the way, that would be more bullish for commodities. So maybe that gold chart is in a new rally. Oil is breaking out, which would make sense. And so that's kind of the normal relationship: is dollar weaker, commodities stronger, dollar stronger, commodities weaker. Now, what we had through here is we had dollar stronger, commodities stronger, or at least with oil, and that's usually not the normal relationship. Usually it's an inverse relationship, so we'll continue to keep an eye on that. And then the VIX coming down. We want to see that with any rally, but now what we want to pay attention to is, do we see a day, like I said, do we see the market gap up tomorrow and the VIX flat or down a little bit or even up a little bit? That would tell me that professionals are not trusting the rally. They're still buying, but they're buying protective puts along with the stocks they're buying, and so they're hedging a little bit, and they're not going to do that. Why spend that money if they're confident that it's going to go higher? There's no reason to buy those protected puts if they do it. So if they do that, that tells you they're not trusting the rally, and that can be a signal that the rally may not last. Now, the VIX doesn't always signal that. Again, most of the time, the VIX is just telling you what we already know. Like today, it's market's up, VIX is down. What you want to do is pay attention if it's moving in the same direction as the market. Pay attention, or proportionally, it's not moving the way it should. You have a big up day and a small down day on the VIX. It is behaving the way it should. It should be down with the market up, but with as big as the market move up, in fact, I would argue that today, that as big as the market is up, and maybe we faded a little bit here, and I haven't seen it yet, the VIX is really not down. I mean, the VIX was down a lot further yesterday, so maybe that is a little bit of a warning that we're not down very much in proportion to the move up. Now, you always want to compare the VIX to the S&P. So if you look at the SPY, let's look at that again, and we can see, look at that. Look how big that move is up and how small that move is on the VIX down. So you had a smaller move up yesterday, but you had the bigger move down on the VIX yesterday. So let's go back to the VIX here. So see, that's just a very small move down. We're bumping up into that resistance area. Could that mean that there's a little bit of concern there? Now, again, how would I use the VIX to confirm something? Well, again, if the S&P busts through hopefully I'm not rambling, and sometimes I don't go into these classes with a script or a big script. I have a general outline of what I want to talk about. Usually it's the same to go through these different things, but what I try to do in these classes is teach you things that I wouldn't normally include. Like if I were going to design a class, I'm going to pick the most obvious things to talk about, the trend, the stair-step analysis, ABC patterns, things like that. But there's a million little things that happen in a trader's career, little clues that they recognize over the years. Maybe I got burned on something and I see something similar happening, and I say, hey, this is what happened last time. They may not be things that I would include in a course, but they can be little tidbits that can be helpful and really speed up your learning curve, where you don't have to get burned by it like I did, because I'm able to teach it to you. So sometimes I get off track a little bit with some of these little things, but you pick up a couple of them in a class and they can make a huge difference down the road. So I do believe there's value in attending these classes every week if you can. And I try to make sure I don't ramble on to where the classes become too long and too repetitive. But this is a good example of something I may not think to cover in a class, but is important. So if we do break out of this area here, not only would I want to see it close above that area, but I'm immediately going to look at the VIX. I would expect a big move down in the VIX. I would expect the VIX to get closer to down in here with breaking out of that level there, because then that would tell me that, okay, they're not concerned. Those professionals are not concerned. At least right now, they're not concerned that this is just a rally within the downtrend. They're not buying protective puts on that breakout. So maybe we can run for a few more days and keep going higher. Now you still want to keep paying attention. We don't want to go all in at this point, but if the opposite happens, where then you get an up day and the VIX spikes up as well, maybe that could tell you that it's an exhaustion move and they're starting to buy those protective puts again. They're not trusting the rally anymore. This is why we look at both. But again, I go back to what I said earlier. You don't want to assume the VIX is telling you something significant every day. Yesterday, it didn't tell me anything significant. Market was up a decent amount. VIX was down a decent amount. Today, maybe a little bit of a clue there. Market up big, VIX is just down a little bit. Right at this resistance area, we'll see if that is foreshadowing some sort of reversal day tomorrow. Chip stocks having a nice day with NVIDIA, but again, we're looking at, is that just that bearish ABC pattern? I'm not in the SOXS right now for that reason, that it looked like it could rally. It was looking like it could rally yesterday. But if I get a bearish reversal and it looks like the market could drop, I'll be back into those inverse ETFs. I'll show you a couple of those here in just a second. Transport's having a nice strong up day though. And you compare the transports with the Dow. And this is a little bit surprising because we were really kind of compact right through here. I thought we were pretty close to getting another move down. Now, this could just be wave C, and then it could reverse back down. You got a real strong up day right here, right before getting a bearish inside day. Maybe something like that happens. But again, it could mean that, remember, transports tend to be a leading indicator. If we start seeing the transports start breaking above resistance levels, that could be a sign that could be a leading indicator that maybe the market is going to rally more significantly. Question, can you restate what you said about the VIX relative to the pros thing? Well, remember, the pros are, the VIX is telling you the level of freaking out of the big institutional traders. That's my definition, because it's simple. It's less complex. Now, there are times when they're really freaking out. The VIX is spiking above 30, is spiking above 40. That's telling you they're really freaking out. And there's subtle clues. They're maybe not freaking out, but they're concerned. Now, the VIX is going to typically move in the opposite direction of the market. So when the market is dropping, those professional traders are going to buy protective puts to protect their stock positions, so that it's like insurance for their stock positions. Those puts will go up in value when the market goes down in value. But they've got to buy them. They cost money. They're cheaper than the stock prices, but if you look at option prices, you can see what those are in relation to the stock prices. So they've got to decide, is it worth paying that money? Is it worth spending that money for the protection? I mean, how many of you feel that way with like your insurance that you pay? You know, I've never been in a house that's had a flood. And I'll look at flood insurance and be like, do I really want to pay for flood insurance? No, I don't think I need it. It seems like just a waste of money. But what if we get reports that the dam upstream is starting to break apart? I will buy that flood insurance. I don't care how much you want to charge me. You want to charge me $5,000 for that flood insurance? Give it to me now, right? I'll pay whatever price because I feel like I really am gonna need it. That's the decision that these professionals are trying to make in relation to their stocks. They don't want to spend $5,000 if they don't think they're gonna need it. But if they really feel they're gonna need it, they're gonna do that, and that's what the VIX is showing you. The VIX spiking up above 40 is those professional traders saying, I don't care what you charge me for those protected puts, because those protected puts go up and down. They charge more for them. I don't care what you're charging me. I need it. And I'm willing to pay it. And that tells us as traders, okay, they're freaking out. We need to be freaking out, or we need to sell because we're going lower. All right. So hopefully that answered your question there. That's kind of that relationship we're trying to read there. And what I was pointing out on this one was just, we're seeing a big up day in the S&P. Look at that size of that candle right there. And you compare that, normally you'd expect to see the same proportion move down in the VIX. But you're not. In fact, you're almost seeing the VIX trading higher than where it opened, the VXY trading higher. This is not the true VIX indicator. This is the ETF where you could actually buy the VIX or short the VIX, which I don't recommend doing. If you have another charting service, or you can type in VIX and see the actual VIX indicator, because this is, when I talk about the VIX being above 30, these numbers on the VXY aren't the same as the VIX. So for instance, I use TradingView as my other trading software, and so I can go to the VIX here, and I can look at the actual VIX, and if it gets above 30, it's telling you that the traders are concerned, or the professionals are starting to get concerned. All right, Bitcoin, not much. It's been moving sideways. Previous move was down. You'd expect it to go down, but it could have a little bit of a pop before it drops. You hear me talk about that all the time in uptrends. We have a real sideways move. Sometimes it takes a dip to attract those buyers. I talked about this on Tuesday, I think, that kicks it up. Same thing can happen on the downside. Sometimes you need a rally that gets the shorts to a level where the shorts feel like they want to jump back in again. They start shorting the stock again, and that could drive that price down. But it's acting like it wants to continue to go down. Now, I haven't updated this watch list for a while, but I have an inverse ETF watch list here where I don't like to trade these more traditional ones because they just don't move. I think I shared this with you back when we first started to hedge. But the SH, this will go up when the S&P goes down. Well, the problem is that we were down. You look at it down here. You buy it at $13, almost $14. It has this huge move up, and you barely made $1. It went to $15. that same move on the SOXS, the inverse for the chip stocks, would have been a $15 move, over that same distance, and that'll hedge it, that's movement there. So I don't like to use this one. And like I said, I haven't updated this list. There are others, but here's the SOXS, the semiconductor, again, inverse ETF. You can see it's down big today because the chip stocks are up big today. But if this shows me a bullish reversal and a market looks like it's going to drop, I'll jump into this, and you can see that same distance, it went from 33 to 40. It was a $10 move, okay, as opposed to a $1 move on the SH. So now, again, that could work against you, if you're on the wrong side. That's why I jumped out of this earlier. It was giving me there's a bearish engulfing pattern right there yesterday. But, it could drop. Here it dropped $8 today. I don't want to be holding this if I think the market's going to rally or the chip stocks are going to rally. So you got to be. This is one where you're not going to use the signals at all. You're just using it if you feel like the market's going to drop. You're going to get into these to make money as it's dropping, or to offset maybe losses in your long positions. I mean, I've got my oil stocks, my defense stocks, and I want to stay in them. And so this allows me to. There have been a couple of days where I've made some money on those other stocks going up. The market's rallied and made a little bit about those, but I lost some money on this one going down, and it just basically I'm at break even, and that's okay. I mean, if I can just make a little bit of extra money with hedging like this during some of these drops, I'll be happy. The big thing is to just get to the point where we bottom out and we can go all in and really ride these trends up. We want to be able to get to that point. So another one, the SARK. This is the opposite of the ARK Innovation Fund, which is a lot of small cap stocks in this fund. ARKK is the Kathy Woods fund. She got into a lot of these risky companies that she felt like were going to be the next Facebook, be the next Netflix, and she may be right down the road, but she's gotten clobbered. Everyone was praising her back in here where her fund went straight up, and she was the genius of Wall Street. And you can see how fast it can happen. You can become the joke of Wall Street pretty quickly. And part of her problem is she doesn't know how to read a chart. She's been hanging on to these positions. She wants to be right. She wants to be able to brag to everybody that, hey, I told you these were going to be the next Netflix and blah, blah, blah. And like I said, maybe they will, but she may be out of business before that happens. Anyway, somebody as this thing was trending down quite a bit, they started that fund to go opposite of what she was doing. And they created this fund, this ETF, the SARK, basically short ARK. And it goes so it's been going up over the last, as her fund's been going down. Now, to me, obviously her fund's up today. It looks like this is just forming a larger bullish ABC pattern, and then it should continue to go higher here. So I'm out of this right now as it maybe drops a little bit. Maybe the market rallies a little bit further here. But I'll jump back in this one again to hedge if it looks like things are rolling over. So this has kind of been my trade against the small caps. You can also, here's one that's a little bit better than the SH. It's the SPXS. This is again just short the S&P 500, but it's a leveraged ETF. I'm a little bit careful with leveraged ETFs. you only want to use these when you're about to get a sharp move down. The longer you hold these, I don't have time to explain. You want to Google dangers of inverse ETFs or leveraged ETFs. Not inverse is not necessarily bad, but the leveraged dangers of leveraged ETFs. And there's a lot of articles out there you can read about how their calculations work and how holding them over a long period of time actually could lose you money as opposed to you think you're making tons of money. But this is one. So again, where the market's making that bearish ABC pattern, this is looking like a bullish ABC pattern right here. By the way, I love to use these inverse ETFs charts to help with some of my biases. If I'm really bullish on the S&P or something, I'll go look at the inverse chart, because sometimes the inverse chart, it's showing you the opposite. Sometimes I'll be like, boy, the inverse chart looks really bullish. Maybe that means that the regular market is going to go down instead of up, and sometimes it can help with your bias a little bit if you look at the upside down chart. You're looking at a different perspective. So not a bad idea to have this in a watch list to kind of check on sometimes. But this is one that you can use. It's a little bit better. If it rallied back up to the top of this range, you're going from about 23 to 26. There's a $3 move there. It's not like the $1 move on the SH, but I still like these ones that we're using right now a little bit better. Another one for the Nasdaq 100 would be the SQQQ, short the QQQ. And again, this is looking like a bullish ABC pattern right here, coming back to support. Remember, this is that resistance back on the other chart. We'll see if we get a bullish reversal candle on this. But this is one, again, if it went back, this is one I like to use, because if it went back up, from about 50 up to about 60, there's a $10 move. So this is one we could add with the other ones if we want to have something more specific to the Nasdaq 100. All right. Now, what I decided to do, I got to do this quick, but for the stocks that, this is a stock specific class, so we want to have some potential trades there. Well, actually, before I go to the watch list, let's go to, let's do a sector. I'm going to go to the computer and technology and to the hold section right here. And the reason why I'm not going to any of the ones up above it is we already have most of those stocks in our watch list that were in the portfolio. But there's a couple I found here that are interesting. This GoGo Incorporated, GOGO, 95 strength rank. But you can see this is a good example of that bowl-shaped, it could be that bowl-shaped move that I like to see. When you get to the right side of the bowl, this is usually where you want to be looking to get in. So we can wait for that to go to there's a couple things I would do. Before I'm getting into computer and technology stocks, I'd like to see us break above that resistance level that I just pointed out earlier in class. But this is one that we could add to a watch list. Let's go ahead and add it, because if it does look like the market's going to take off, then we already want to have stocks that we could jump into, be ready to go if that happens. Another one under computer technology is the Silicon Motion SIMO, 93 strength rank. I am coming down. I usually like that 98 strength rank or above, but until I see a pattern I like, I can kind of come down the list there. As long as we're in the 90s, we're usually okay, especially if you have a good pattern. But I really like this. This is kind of the potential of that other bull-shaped move on GOGO. You got this bull-shaped move, and then you got a kind of an ABC pattern right here. There's also what we call a potential cup with handle pattern. You get a cup, and then it kind of consolidates through here, and then it breaks out. And when it breaks out, the thing we love about cup with handle patterns is you can take the distance from the top of the cup to the bottom of the cup and project that upward. And that gives you a rule of thumb of how far that stock could go out of that breakout. Doesn't mean it always does it. Doesn't mean it has to do it, but that you can see here, that's real potential. Now, you'd probably need more of a bull market for it to go that far, more bullish conditions, but the stock has held up pretty well with the selling recently, and I'd probably wait for the breakout, because why not? I mean, if it does, it probably means the market's looking a lot better, and but that's a very bullish looking formation there. So I definitely want to have that in my watch list. And then I went through the watch list, and I'm just going to highlight the ones that I like. Obviously, USO, I'm already in this one in the portfolio, but if you don't have oil exposure and you want to get into something, this is breaking out right now, and it's looking pretty good. Some of the defensive stocks, Lockheed Martin, looks like it's going to a buy signal today. It's been consolidating through here. Again, this is another one where you could wait for it to break out if you want a little bit of extra confirmation. Because if we do start really selling off in a panic sell-off, all these stocks are going to come down with it. Everything starts selling off. Just be aware of that. Arch, this is a coal play where it's starting really close to breaking out. Nice big update, going to a buy signal today. I already have coal exposure in the portfolio. I'll look at the portfolio here in just a second. So that's why I'm not adding anything today. I've got all the stuff I want to have right now, but these are positions that could be new positions and new entry points. And VET is an oil trade. Again, a lot of these have been consolidating for a little while, but oil is now breaking out. A lot of these should break out too. They should continue to move up and break out of these ranges, and that's gone to a buy signal. BTU is another coal trade, and it's looking like we're forming that kind of that bowl-shaped move right here. Now, I'd be a little bit cautious on coal. Obviously, coal is an energy play, and obviously there's demand for energy. But remember, a lot of the demand for coal is a little bit higher in the wintertime as people use it for heating, and moving into the summertime. Now, it's also used for electric plants producing electricity, and you need electricity for air conditioning this time of year. But the demand may not be as high as it usually is in the winter months, so that's why you don't want to have too many. Maybe a coal stock just to have some diversification within energy, but I wouldn't get too crazy with coal compared to other areas. Get into diesel. Anything that has something to do with diesel right now. Diesel, talk about crazy inflation for prices, man. Those prices have doubled. I feel sorry for all the truck drivers out there. A couple more here. KOS, another energy. Same idea that if oil is breaking out again, this could end up breaking out. It's gone to a buy signal. Nice pullback right through here. Kind of an inverse head and shoulders pattern right here as well. Breaking out of the neckline. And then Coca-Cola had a big drop, but it looks like it's possibly part of just an ADC pattern. Nice recovery, sharp move back up. Consumer staple, people are going to buy Coca-Cola whether the economy's good or bad, and you could wait for that to go back to a buy signal. And these are just out of the watch list. There's no reason to have a watch list if we're not going to look for opportunities within our watch list. Real quickly here, the portfolio. Let's go through. I'm not holding any of the inverse ones right now, just because if I see a bearish reversal tomorrow, then I'll probably add it, but I don't see a reason for it just yet. NOC looks like it's getting ready to break out. This is a defense holding. Here's oil breaking out. This is my coal trade right here on Console Energy CEIX breaking out. CF, these are, I got fertilizer and I added Archer, Daniel, Midland, ADN. We'll look at that chart here in a second. This was down today, but overall it's kind of the same idea that it's consolidating right now. Should start to move up, especially, you heard me talk about the argument about wheat with Ukraine being I hope I'm saying that right. I think they're the fourth leading wheat producers in the world. I've been saying that for a while, but they're up there pretty high as far as world production, and so there's going to be big demand for wheat in particular. And this is a fertilizer company. My stop's down below here. I kept a pretty tight stop, knowing that I could get back in it again if I needed to. So we're getting close to the stop on that one. Hopefully it doesn't get there. Chevron, another oil trade as it's breaking out. And then here's ADM, Archer Daniel Midland. It's in the agricultural operations sector. There's a pretty big one though. When people trade, commodities like wheat and stuff like that, they'll trade ADM. Big run up it's had already, probably anticipating all that stuff happening. But it's had a nice little pullback right here, and I think if this goes back to a buy signal, you could. I got in this one a little bit earlier with a tighter stop. My stop's just right below here. I got in. I think I was in last Tuesday. I think I went over. I don't know if I went over the portfolio last Tuesday, but I got in somewhere in this area right here because I figured this was. If it goes below here, I probably don't want to be in it for a little while and let it start showing me it's coming back up again. But I thought that was a good aggressive entry to go ahead and get in right there with a tight stop. All right, so that's it. And you can see I got the majority in cash. Now I am overweight in oil and energy. I know that, but I've got stops, and I can jump into those inverse ETFs if I'm reading that on the indexes. And I think part of the when people get overweight, when people get overweight, the danger in getting overweight is in a sector or area is if you don't know what you're doing, if you don't know how to read a chart or read what's going on. Although there is always danger that you get a massive drop in an area, especially if you're in like biotechs or something, you could have these biotech stocks lose 80% of their value in one day, and you do have that danger of the whole group getting hit hard at once. But in this case, I mean, this is what's been going up when the market's been going down. It's like the other option is to not have anything in, just be in cash. And if some of these you can make a little bit of money on, and like I said, I'm confident in my ability to read a bearish reversal of some sort where I can go ahead and take profits and get out. And so I don't, the only problem would be is we don't get a signal, meaning that some news comes out on oil and it immediately overnight causes a big gap down or something, and that's always possible. But I'm okay with that at this point with the positions I'm in. All right, let's wrap things up. Have a good weekend, everyone. Again, remember, Monday is a holiday. And hope you have a nice holiday weekend. And we'll see you back here next Tuesday for the market update class. Bye, everyone.